Hello, everyone, and welcome to the panel on cryptocurrencies and central bank digital currency CBDCs. We're trying to explore the question of what are the roles of private sector and central bank. With me, we have a very exciting panel here. But before I introduce the panelists, I also want to give a quick shout out to Chorzempa, who is the brainchild of the session and who orchestrated all of us and who is really in charge of us here. So my name is Andreas. I'm a professor of finance at the University of Toronto, and I'm also the research director of our financial innovation lab, the FinHub. With me, I have Morten Bech, who is the head of the innovation hub at the BIS, at the Bank of International Settlements. We have Catalini and Dante Disparte from the Libra Association. Christian is the chief economist, and Dante is the vice chairman and head of policy. And they're going to give us their perspective on the Libra Association and their latest developments in terms of developing a new financial infrastructure. We have Morten Chorzempa from the Peterson Institute. He is a research fellow there with a specialty in China. We have Cunha from the Federal Reserve Bank of Boston, and he's going to give us information about their initiative with MIT on experimenting with the CBDC. And we have Andrei Kirilenko from the University of Cambridge, who is a professor there and who has done some extensive work on fintech innovation. So with that, what we are looking for, just to give you the big idea of the agenda, what I would like to get people out of this panel discussion is I want you to know where the central banks in the world stand with regards to the development of general purpose CBDCs. In case it's not clear, there's also the possibility and the thought about having a wholesale CBDC, where wholesale CBDC would be something that's used only by the financial sector, but not by people. We're interested here in exploring CBDCs that are used by normal people. So these are generally referred to as general purpose CBDCs. Now, then we also want to know where Libra is, as in particular as a very prominent public sector entrant in this space. And I want to know where they stand and how the financial system will look like in 5 years from now. Now, this is a big topic, big questions, but this is essentially what we're after. As in the other sessions, you have the opportunity to post questions in Slido, where you go to slido.com/fintech and you can put your questions there, and I will be monitoring it in case there's any questions for our speakers. Now, with that, I would like to start by asking Morten to maybe give us a big picture overview of where he thinks that central banks are at this point with regards to the development and deployment of CBDCs. For those of you who don't know, the BIS has an annual report, comes out usually in January. They did this in 2019 and 2020, reporting on where the respective central banks are, and maybe he can give us some big picture overview of where things are going. Morten.
Thank you, Andreas, and thank you for the kind invitation to speak at this great conference. I'm very honored to be on this panel. And so let me just start by saying that we at the BIS Innovation Hub are very excited about the strategic partnership that we will have going forward with the Federal Reserve System. But let me actually start with before I get to your question around where central banks are on CBDC, actually let me start with perhaps a weird confession. A part of me is actually a bit sad that President Trump lost the election. And why? Because it actually deprives me of my only CBDC joke. So for a number of years, I have been running around saying that central bank digital currency is about making M0 or base money great again. So why do central banks need to or want to revamp base money? So let me offer two reasons. First, cash is not all that great anymore. Not surprisingly, cash is too old, too slow. It's too local. Cash is face-to-face and not useful in an increasingly global and virtual world. It's obviously too expensive. While banknotes are actually cheap to produce, and the whole cash ecosystem is actually quite expensive. And then cash is too dirty. Cash facilitates all kinds of shady transactions. I like to say if you were to invent cash today, you would not be allowed to do it due to anti-money laundering and other things. And then, as we have learned recently, cash is also the carrier of all kinds of nasty stuff, and with COVID-19, that can even be deadly. I'll have some comments on Libra maybe later. But I think coming back to CBDC, I think, the concept is not new. CBDCs was actually proposed decades ago. Tobin argued in 87 that everybody should have a central bank account, which would be a form of CBDC. But as you mentioned, for the last 3 years, the BIS has run a survey of what central banks are doing on CBDCs. And in 2018, the theme was kind of like proceeding with caution. So basically, a lot of central banks were doing research, but, everybody was really proceeding very cautiously. That kind of changed just a year later. The theme of our survey was really the impending arrival. So what we found was that 20% of central banks said that they were likely to issue a retail or general purpose CBDC over the medium term, which would be, I guess, about 3 years. And almost 80% of central banks were active in some form of research, experimentation, or even development. And I also think other BIS analysis or research have basically shown by looking and using also Google Trends, as we heard about before, but also central bank speeches, that central bank stance vis-a-vis CBDC has become much more positive than 2018. And so the next central bank CBDC survey, the results are coming in, and it's going to be published towards the end of this year. And I don't know what the theme will be, but I think maybe it could be it's a new dawn, it's a new day would be an option. I think we'll definitely see an increase in central banks' engagement in CBDC work, and we're actually seeing a lot of central banks being even more involved in development. So there's the whole Chinese experience that one of my co-panelists is an expert on, but also there's the Bahamas sand dollars, and so there's a lot of central banks actually doing quite a lot of stuff. And I think when we ask central banks what are motivating them, it's still the old motivations, such as financial inclusion and payments efficiency and safety. But also this year, it's clear that the COVID pandemic is playing a big role and actually might increase the likelihood of central banks adopting in some jurisdictions. So let me leave it there, but maybe just like as a final remark, I think overall we're basically seeing two trends, both with regards to digital currencies, which we also survey a little bit, but also central bank digital currencies. That it's very hot right now, but most of the action somehow is in the tails, if I can say it that way. One is that it's either in the very highly decentralized versions of digital currency or in the very centralized versions. So centralized versions would be central bank digital currencies, but in the decentralized version, there's a lot of action in what's called decentralized finance or DeFi, and it's kind of almost exploding at the moment, basically using primarily, I think, Ethereum. And then for where the CBDC is really hitting the road, I think it's either in the very small countries. I mentioned Bahamas, but also the Eastern Caribbean Central Bank, the Marshall Islands and Uruguay, and then in China, so the largest country basically. And then you can say that maybe Sweden with their e-krona project is a mid-sized country, but that's then the exception that makes the rule. So let me end it there and hand it back to you. Thank you.
Thank you, Morten. This raises all kinds of questions for me already. I want to just quickly hark back to one of the few things that you started off with, because you mentioned in the 1970s the idea of a Fed account, where basically every citizen, I understand, of the US would have access to an account at the central bank. And you talked a little bit about the solutions could be very decentralized or very centralized. And maybe we could just briefly go back to that for 1 second. So, in your opinion and what you have seen, what is the most common approach that you see from the different banks. So my understanding is you can have an approach where, as you say, everybody has an account with the central bank. You can also roll them out using the existing banking sector, which raises its own set of questions. So you can have a hybrid version where you actually use, say, an existing blockchain technology for it. What is your impression of, say, the small players and some large players? If you can give an example for each of how they're going about deploying it.
Yeah, I think well, the large player, China, is definitely using the approach where they would still somehow rely on the existing banking system. But it's important, at least at the BIS, we kind of find that, you know, a CBDC has to be a direct claim on the central bank. So there's these things that are called synthetic CBDCs, where whatever you hold on the banking system would be actually a claim on the bank. It would be backed by, you know, reserves or something else at the central bank, but we don't consider that as being CBDC for different reasons. There's a new report out that actually details that in some form. And I completely agree that there's many forms of potential designs. And I do think that what you hit on there is that a key distinction is the degree to which the central bank interacts with the end user. And I do think that so FedCoin, which was a proposal a couple of years ago, would be a central bank cryptocurrency, which actually would have a very high interaction with the end user, whereas the current Chinese proposal, pilot, the existing banking system is still being used to distribute the central bank digital currency. Some of the smaller countries are actually going with the blockchain design, so that's going to be interesting to see how that develops for them.
Okay. Now, speaking of China, I want to come to Morten and have a conversation with you about how China goes about things. And that kind of brings us back to cash being dirty in a way, right? Because as Morten said, you know, you wouldn't be allowed to issue cash today if it wouldn't exist already, simply because it is anonymous and you know, untraceable. And you know, think of China. This is one of the concerns that people may have with the involvement of the Chinese central bank and their design. So maybe you can enlighten us on their particular approach, their thinking, and in particular what they're trying to accomplish over and beyond what already is in place there with an extremely fast and modern payment system with Alipay and WeChat Pay.
Sure. Thank you. So I'll start off with a few of the acronyms, because otherwise it can be an acronym soup. The CBDC of the PBOC is DCEP. The PBOC is People's Bank of China, the central bank. DCEP is what they call it. It's quite interesting. It's digital currency / electronic payments. I think they understand that with these CBDCs, we're not just talking about currency per se. We're also talking about a deep integration and payment system that's associated with the currency. I'll just start with some background. I think it's safe to say China is the furthest ahead of any major central bank in launching the CBDC. They started serious research back in 2014 with a dedicated team, entered a retail pilot last month in Shenzhen. That's an airdrop of currency. So essentially, a large number of people applied for a lottery, and then about 50,000 people were able to get just a drop of 200 free digital renminbi, and then they could try it in this small area. I think they did that so that they could avoid testing what might not yet be ready, which is the way to buy and sell the DCP, the way to closed loop system. They said that there were 3 million transactions and 1 billion renminbi transacted so far in this system as of mid-September. So it's already moved forward quite a lot, although it's geographically limited. Still, there's no official timeline for final release of CBDC in China, and I really think that there are still many important design decisions that remain to be made and consensus made around those. So why is China issuing a CBDC? I think a few reasons, some unique to China, some that are common to many other countries. First is I think China was really struck by the first real takeoff of Bitcoin in China and the huge speculative wave that happened there. And they really felt that they were on the back foot responding to innovations coming from outside the country. And then the same happened again with the ICOs, initial coin offerings and that boom. And China came away from that thinking, we want to shape how the technology, new technology and payments and investments is applied in China rather than responding to something outside. They also see a soft power benefit to being a leader in fintech. That means both in terms of private companies and in terms of being a pioneer in CBDC. In terms of domestic interests, they want to extend, like many other central banks, a public option for payments into the digital era. As Morten said, cash is not very useful in the digital era right now. And then there's also a political economy angle, as we've seen with the Ant Financial IPO and the extreme reaction to the Jack Ma speech. There's a strong interest in reining in the power of private tech giants. They currently dominate the payment system for online payments in China. All of this, I would say, is a concern, but was a concern in China. A reason they were pushing this before Libra, but they said that they accelerated their plans after because they viewed it as a threat to monetary sovereignty in China. It's very easy for them to just ban Facebook in China, which they have done. But if Libra was as successful in its area as WhatsApp has been in totally heading off any of China's internet companies in an ability to expand abroad in social networks, then China would be isolated, and it would be and blocking Libra in that case would be a huge negative for their companies. So they really did not want to be in that position. I think lobbied hard internationally to try and put as many rules on as possible so they wouldn't have to compete with it. Now, some brief characteristics of CBDC, of the DCP in China. It's really hard to say much definitively because there's no white paper. You have to kind of put together a patchwork of speeches from different officials over the last few years and maybe reference some of the patents and research papers that come out of the Digital Currency Research Institute, DSC, but there's no place that brings that all together at DSC. What we do know is that they are treating it like digital cash, and it combines elements of an account-based system and a token-based system. So if you want to transact with very small amounts and you hold only a little bit in your wallet, you can do that without really providing any identity information, without linking it to a bank account. And they say that you'll be able to actually transact offline. The idea being if you're in some rural area without good internet access, you can still replace cash with a CDP and transact in this way without, if you don't have a bank account and if you don't have internet access. That's one of the financial inclusion angles. But of course, those thresholds are going to be very, very low. And you're going to have to provide more identity information coupling with an account if you want to do actual use for more day-to-day transactions. They say it's a two-tier system. Nobody is having a direct account at the central bank. They say that they're referencing the current system for how cash is distributed and transacted, which means the PBOC will issue this directly to banks. And then banks are going to be the agents of the central bank that buy and sell the digital currency. So the idea is you can't go onto Alipay and buy digital currency from Alipay, but you probably can. They've said that this is not going to compete with Alipay, but kind of coexist with it. That you can use your bank account to buy DCDP at a bank and then transfer it into your Alipay wallet and then transact with it within there. So there's going to be a very interesting set of interactions between the current dominant payment providers and the PBOC. It's 100% reserve backed, so there's going to be no interest and no ability to use this for fractional reserves. So my expectation is that they will try to make sure it's not too successful, because if it is, it's going to remove liquidity from and disintermediate the banking system and potentially lead to, the PBOC officials have actually said that would bring us back to 1984, back when there was kind of a monobank system in China. I know 1984 means something else for us, but to them it's back to the monobank system where the PBOC just controlled the entirety of liquidity in the economy.
So can I interrupt you for 1 second? Because you said all interesting things. The one thing I would actually be interested in is, so they went and they go in the route where they include in the banking system. Is that a convenience question, or is that, so going back to your 1984 question, or is this a question of trying to take Alipay out of the equation a little bit? I mean, you said they don't want to have it compete with Alipay and WeChat Pay, but what's the point then?
Well, I think they really want to make sure that this is not going to be a disruptive impact on China's financial system. So we're going to tell the banks they're fine, But then locking Alipay and Tencent Pay out of the system definitely seems to indicate that they want to preserve a privileged position for the banks as compared to the private sector. The big question is, currently they're saying the system is going to be free, but in the most recent speeches they said they recognize there's going to have to be some fee revenue that is allocated to market players who incur costs to onboard people on the system, process payments, and all this. But that seems like it's at the very early stages of being fleshed out. A lot of the regulations in payments recently has been actually cutting into payment systems like Alipay and WeChat Pay's ability to make money. For example, on float, all of that money has to be put into the central bank at the moment, and they don't get any of the interest on it. And they've also sort of nationalized the system for interbank payments that was created from the ground up by the tech companies and centralized that. So we see increased control from the PBOC at every step.
Okay. So now one thing that you said that struck me also is they don't want to be disruptive. So to some degree, and this brings me to Libra, I'm always a little bit disheartened by that. The way I look at it is, if you look at the US, for instance, you have a country where 26% of people are either unbanked or underbanked, where they don't have access to a bank account, where you have a large part of the country where people, have maybe one bank branch within a 100-mile radius. Yeah, I think you can easily argue that the banks in the US have failed the American public. There's different viewpoints on that one, but, I'm going to take an extreme stance here. So a lot of people are left behind, and I have a colleague who does research on that. Once you give people access to a bank account, their financial well-being improves dramatically. So I find that, this trip-strapping around and trying to not disrupt the poor banks and, eat into their gigantic profit margins that they have from payments, which essentially is a commodity. They treat it like a service where they make, margins that are, astronomical, considering that it's really a commoditized service. So this brings me to Libra, because it seems like we hear a lot about that central banks have been studying this for a long time. They've been at it for 2014, but Libra's announcement has really, I think, jolted everybody a little bit to action and, showed that maybe there is, the current world is not quite so compatible with the digital world, at least the banking world and the financial infrastructure is not. So now I would like to, not that I want to tote Libra's horn, and there's many things that we have to discuss about what they want to do, but maybe you guys can tell us a little bit about what your view is and what role you envision for yourself and for Libra in the coming, battle of payment systems, if you want. Dante, maybe you want to go first?
Sure. Well, first of all, Andreas, thank you so much for moderating an expert panel, and thank you to Chorzempa and colleagues for giving us the chance to share our views in this discussion. So, my point of beginning here is always the human level. I come at it from the lens of not only someone who's looking at financial services in my capacity with Libra, but also someone who serves on the Federal Emergency Management Agency's National Advisory Council. And so picking up maybe where Morten left off, that if you were going to invent cash today, it probably wouldn't have a physical form. And then you take with it the perfect storm of the COVID-19 pandemic and how even fortress nations such as our own have realized what is effectively the point of diminishing returns of a financial system that in some respects rides on the back of brick and mortar infrastructure, goes to sleep, has bank holidays, and doesn't necessarily empower the end users in that system. So if you begin there, the question of projects like Libra and the question of fintech and how to appropriately promote innovation, both at the core and on the edges of the financial system, in my mind, is less about revolution and more about evolution. And that so much of that is very true in this crisis, right? That the lack of optionality in payments is revealed post facto as a vulnerability in the United States, and it's a vulnerability around the world. The inability for us to, as a government, to advance real-time direct payments to citizens is a vulnerability that we would only know as a vulnerability in the context of the COVID-19 pandemic. The fact that, the world's most important global cash flow, a larger cash flow than foreign direct investment or official government development aid, in the form of in the form of remittances or peer-to-peer remittances, pre-pandemic labored under a 7% global drag in terms of cost, is very physical. It takes time to clear. Only in the context of COVID-19, we realize that we're now putting an added penalty on the poor for that cash flow. And so in that vein, it's hard not to see all the areas in which technology, appropriately harnessed and appropriately managed, could fill a void and fill gaps in our domestic payment landscape as much as our international one. And then you add in this other layer, which I think gets to many aspects of what Libra really is all about. And that is the fact that our core technology for value transfer is somehow stuck in a 30 or 50-year-old standard and has failed to modernize in the same way that information technology and the internet has advanced not only in terms of empowering people in the flow of information, but has also empowered a range of different business opportunities on top of that. And so if you think about our project, it really is open source technology. It's a blockchain design that is designed to take into account, not only in terms of the conduct of the organization, but in the code, the global compliance frameworks that would apply to it insofar as financial integrity are concerned and anti-money laundering and countering the financing of terrorism. Effectively, we're enshrining the value systems that have kept the modern financial system safe at all levels of the architecture of this project. And then lastly, to do this in a manner that also spurs competition. If there's anything that is desperately needed, in particular when you think about cross-border payments, which often ride on the backs of only a small number of providers that have either a duopoly or a monopoly control over many remittance corridors around the world, to spur much more competition through an open source design and through trying to frankly harmonize the regulatory treatment of this asset class and these types of innovations, are many of the ways in which a project like Libra would be and would have been a difference maker in the context of the COVID-19 pandemic. Where we are now, and I'll let Christian add some commentary to this, of course, we are still getting the project to the starting line, the Churchillian end of the beginning. That, of course, includes continuing review of the payment system application and license through the Swiss regulator FINMA, continuing dialogue with, frankly, many of the stakeholders who are probably participating in today's discussion on a model in which innovation, inclusion, and financial integrity are not trade-offs, but can move in lockstep. And this includes ongoing engagement with bodies like the Financial Stability Board, the FATF, and a number of international bodies. We're putting, I think, a very high standard on how fintech applications can be brought to bear on financial services without sacrificing those rules. So we're taking all of that to heart, but I think the void in the marketplace is very clearly and passionately pointed out by a number of my fellow panelists today. And in a world in which these innovations can exist, we can move the needle, I think, pretty dramatically on the movement of money.
So, obviously this sounds, very friendly to the world because you want to include financial inclusion, you want to bring payments to people who haven't had it. So this all sounds nice. Now, I want to pick up on two things. So one of the things that you, I think, wanted to say, that as I understand it, is what money lacks today is that it's not programmable, if you want, right? If you look at what you can do on Ethereum, this is great because you can actually have a lot of things in one particular database or in one particular system. You can do operations that you can't do currently, such as it is. Just very, very briefly, can you see that Cbdc would be playing a role like that? Could you envision that CbdCs will actually be issued, in particular via the existing banking sector, as being programmable? And is that something that is a requirement for you as Libra to interact with the system? If you could do that short, would be great.
Yeah, maybe I can build on that. So, from an economics perspective, probably one of the most important features of our project is really interoperability. Daryl Duffy has a really interesting piece on CBDCs, and he stresses the point of how they can really enable through interoperability in the payment system. I think when you look at competition, market structure, and economic outcomes, most of it is a result of a lack of interoperability. Our payment systems are siloed, and as you think at that transition from a world where we do have digital money already, we don't have necessarily programmable money, and we definitely don't have something like a wholesale CBDC to one where you would have such an asset. It's important to think about the different layers. So there's, of course, monetary policy, stability of currencies. Those are fully into the remit of the public sector, and there's major externalities in those functions. And banks play a major role in private money creation, maturity transformation, and the like. None of that would change in a world with CBDCs. I think what's important to stress, though, is that even if you had a programmable layer offered by the public sector, there is a role for an additional interface on top, actually multiple ones, multiple networks that provide all sort of payment services, financial applications. And those, at least at Libra, we believe the private sector may have an advantage in deploying because they'll be context specific, they'll need to be adapted to different industry vertical and markets, to different consumer needs. And so what the public sector could do with something like a wholesale CBDC effort is kind of retain all the plumbing of the current system and all the protections that it brings, but allow a number of experiments on top. I think one of the challenges, if you look at what digitization did across a number of verticals of society, we've seen massive, massive ranges of new services and products that have come to life and we've enjoyed over the last few decades. The same has not happened when you think about payments and financial services. Now, there's been a lot of innovation, but the market structure is substantially unchanged. And so what we're hoping to do by introducing a fully interoperable standard model after, the standards of the internet that we use every day for email, for the web, and for all of these applications, to allow a new range of players to compete and to serve customers in new ways. I think as Dante was already stressing, the COVID crisis has only surfaced really the lack of innovation in payments and financial services. And this is not even considering some of the most hard-hit countries or people that have been trying to send money home. World Bank data, again, the average cost of sending money across borders is 6.8%, and it takes 1 to 3 days to complete that transfer. When you think about government transfers and cash transfers, 20 weeks, this is like in a developed nation like the United States to get a check in the hands of consumers to really stimulate the economy. So I think there's massive room for improvement, and Libra really wants to be one of these projects and wants to compete with other projects of this type that want to create truly interoperable, programmable infrastructure for payments and eventually also for financial applications.
No, so I have to ask you one thing, and this question has to be asked while Libra is in the room, is you're making a business case essentially saying you're building an infrastructure so that you can create all kinds of higher level services that people can use, and that sounds great. Now, for Facebook, you were always, since Libra is sponsored by Facebook, and really there's not much in terms of financial companies behind it, so you could argue that there's a lack of core expertise, and please don't take this the wrong way. Want to wonder what the business case really is. Is it really that you're trying to solve an inefficiency problem, and this is, you're doing something good for the world, or what is exactly the business case? Do we have to worry about that it's going to be about data, that, you basically just extract lots of data, which then gets fed back into ad placement and so on?
Yeah, I mean, so let me take that one at least to start, and Christian, feel free to add. So look, Facebook is one member among many in the association right now. We have 27 members in total. The project is going to be subject to a very strict regulatory regime and treatment, a payment system license in Switzerland, and appropriate licensing, both at the network and also at the digital wallet provider level. That would include conformity with privacy requirements like GDPR, among many others. And the tension of a, financially compliant yet innovative payment system that also has to address obligations vis-a-vis financial integrity and having a financial intelligence function would be exactly the same type of operating model you would expect in peer payment systems. And I think that, frankly, is a good thing. There is no operating model in this network that would strive to monetize data from the association's point of view. The posture of the association is to comply with applicable regulations around privacy and compliance and a range of other issues. And there is no necessary backdoor here. I think companies like Novi, which is Facebook's wallet, have also stood themselves up to be a completely independent operating entity of Facebook, although a subsidiary, but subject to financial rules around privacy and compliance as well. And I think the question, of course, and this gets to the core of the CBDC versus privately issued digital currencies, it's about core competencies. I'm one who is a big advocate of the concept of a vigorously competitive wallet environment and public oversight over money in all of its form, whether it's digital or physical, That's the operating model that I think, Morten's data suggests the direction of travel around the world is when central banks get over the hurdle of experimentation, we will want a country and a world that has a vigorously interoperable wallet environment, harmonized standards around consumer protection and other standards, that then allows public oversight over monetary policy, consumer protection, and a range of other issues. We're going through that road. We're not trying to circumvent it.
And actually, let me just really briefly push back on the point about the expertise. A lot of this is being co-designed with a number of global custodians. So banks are heavily involved in key parts of the ecosystem, from the reserve to the distribution of coin, because as you point out, I mean, that's really relevant expertise for building a system that is robust and really can deliver what consumers need.
That's good to know. Now, so the Libra Association is a phenomenon which is a private sector initiative that you are now committed to, let's put it, play ball with regulators, which is obviously, for private entity a wise choice. Andrei, maybe you want to chime in. You did your institute in Cambridge does a lot of work on blockchain, generally speaking, on the particular in the permissionless blockchain, which you can summarize probably as a part of an ecosystem which would like to blow up the banks. What is your view on hearing all of this, on the role of CBDCs, private sector, maybe decentralized money?
Right. Yeah. Thanks a lot. Fantastic panel. Thanks for having me here. And there are a few things that came up that I'd like to comment on. Thanks, Andreas. One is, to me, so the word payment system came up multiple times, and to me, so CBDC is mostly about the payment system. And the way that I see it currently is that, and it's been said already, is that we have siloed payment systems under different national jurisdictions. And within this payment systems, these are publicly owned payment system operated by central banks, but they have private entry points, and these entry points are privatized to intermediaries, and intermediaries, in order to facilitate access, charge, as you pointed out, Andreas, exorbitant fees, commissions, and so forth. And if you actually want to link silent payment systems, then the commissions multiply even more. Why? What's the economics there? Why is it? Is that because these intermediaries are mean? No, not necessarily. I mean, if they could extract rent, they'll extract rent. And why are so many sort of retail participants being shut out of it? Well, because intermediaries are going to provide access to those from whom they could extract rents, and they're not going to provide access to those whom they don't. So therefore, that is going to be sort of a natural equilibrium that's going to emerge out of a system in which you have a public backbone with privatized access points. It's sort of not particularly surprising here. So what is if we'd like to bring competition into this, one way, of course, a natural way to deal with this is to provide competition into this system. Competition is going to require figuring out how exactly, at what level do you compete, and how do you put competitive pressure on intermediaries. One way of doing it is to allow multiple payment systems. There will be a public payment system, which is the backbone, which is for financial stability reasons would be argued has to be in place no matter what, and the taxpayers would be paying for that, or fees would be collected to pay for that. And there would be also private payment systems in the form provided by either associations or technology companies that operated on the competitive basis. We've seen that done before in markets. We've seen in markets we've had similarly competition has been introduced in order to do what? In order to bring down basically the rents, the fees, the commissions, and so forth. So then additional questions are then going to come up is, have we seen sort of instances of that being done before, and what are the typical arguments? And I sort of remember reading an article from sort of the innovation literature about a big debate between TV broadcasters and cable companies, when cable companies try to come in and provide content. And the way cable companies were making their point is saying, look, broadcast is not available to some of the areas in the mountains, in the areas that are not really served. I mean, sort of similar that there are some areas out there underserved, in our case, underbanked, not included, excluded from this, and we as sort of cable companies are going to come in and provide these people access. Now, what happened at the end is, at some point it gotten broken down, then additional frequencies were added, but competition was added into the space. Content exploded, possibilities exploded. There's still, broadcast channels that are publicly owned for emergency purposes, but we have a lot more competition, a lot more offering. Perhaps some people would say too much. There's just too much offering, but too much is then for the public to decide what's too much and what's not too much. It's competitive pressures then. So this is how I sort of view a situation here. There will be a rhetoric that there is a need, and it's not incorrect. There is a need to break down whatever is there now because it's not serving. It was designed a long time ago. The technology is there to provide content or to provide services or to provide utility at the end, ability of companies and individuals to do things that they were not able to do before. And why not allow that in? And I am supportive of that. I think I'm mostly seeing it as there will be sort of a trickle first on the basis of this sort of argument of inclusion, but at the end of the day, running a public backbone system with privatized access, it's sort of really outdated. I mean, it's really outdated as market structure. We know that. I mean, we've seen it before in markets. We've seen it before in telecommunications. We've seen it before in the provision of information services. So why not undo it? And this is the vehicle towards doing that. So these are sort of my immediate points on that.
Well, thanks, Andrei. I mean, one could also go the other direction and say we already had a time when we had lots of different types of private money in the U.S. in the late 1900s. This is why we have the control of the currency. I understand that. But on this note, I would like to understand maybe from Cunha. You're working together with MIT on a design not on a design, but on experimenting on CBDCs, on the general purpose CBDC in particular, because there are already existing experiments from the Bank of Canada and MAS in Singapore. So can you tell us a little bit about what you have in mind and what you're particularly looking for? And the one thing, I'm not sure if you have something to say about that, but something that Andrew said and that came up is general access that you need to have for money, right? Which I think can be a challenge, not in the sense of that you provide people with an account, but really to have people all over the country be able to access digital money if they may not have access to a digital network. Chip, over to you.
Yeah, thanks, Andreas, and thanks, Jalapa, for the second invitation I've had to this great conference. I spoke a number of years ago. So to Morten's point, the Fed has not decided to issue a digital currency, but we have decided it's really important to understand the technology and what's possible. I'm a technologist. I'm not a policy person. So what we're doing is we have a multi-year joint technical research project with MIT, specifically their digital currency initiative. And what we're doing is we're trying to build a prototype digital currency. We're technology agnostic. So while we are considering distributed ledger, we're also looking at other types of technology. And the goal is first to build an engine that can meet the unique needs of the U.S. from a throughput, from privacy, settlement time, et cetera, and see if we can build that engine first. So the order of magnitudes is multiples of tens of thousands of transactions per second, for U.S.-based general purpose Cbdc. And so after that first phase is done, then we'll move into subsequent phases where we'll take different policy options, and some of them were touched on in earlier comments. And we'll be looking at, for instance, the trade-off between privacy and traceability. How can an entity do anti-money laundering or know your customer, and how do different designs then affect the network? Obviously, more programmability will likely slow down the system from an engine with less program and less function to it. We're not trying to set the policy. We're just trying to understand the trade-offs, and can we build an engine that can go to those speeds when we look at those different trade-offs. We'll probably look at issues relative to offline transactions, to privacy versus traceability. We're looking at certain features that may be more conducive to the unbanked and underbanked, and also the interoperability and the cross-border question. So those are all effective design specifically. We're then going to publish our joint results with MIT, and then we're going to have an open source license for the code. We're not necessarily doing this just because we think this is the Fed engine of the future. We're trying to move the research forward across the globe in this particular area. And there's not one way of doing this. The second track of what
can I just ask quickly, what's the timeline that you are looking at for this experimentation and therefore possibly for the deployment? Going back to what Morten said earlier, that there's a medium-term perspective for many banks.
Yes, this is definitely a prototype. So it's not a full-blown application. So, for instance, we may not build out what a particular business entity would need to take the Cbdc at point of sale and some of the other infrastructure you would need. We're looking at 2 to 3 years, with the first phase taking roughly a year, which would put it at mid-year next year. But as researched, the timing is going to be somewhat fungible. We're looking at a couple of years, but that would just inform us on what's possible and get to some of the very discrete technology questions we have to answer. It's definitely not going to be a working system that we could suddenly turn on. But then again, we'll be 2 or 3 years ahead of the research, at that particular point. One other thing we're doing is making it as flexible as possible. So you asked the question about, intermediaries in the banking system. We're trying to build this such that it could either be a direct to the consumer model from the Federal Reserve, or it could be have intermediaries, be they banks or other technology companies, or a hybrid. So we're trying to build it such that we're not going to bake in that design and policy option up front. It does affect the design, but we think we can build it in a way that allows for different possible models. We also think the innovation can happen in that last mile or so between the consumer or the business and the platform itself. So we think there's plenty of room for innovation. I'll also mention that there are a number of private sector actors in the payment system today, be it PayPal or the credit card companies, debit, et cetera. So it's not strictly a public network. There are many private sector actors. And what we're trying to do is make this as flexible as possible. So whatever the future distribution model is and what innovation can happen, that we'll be able to handle that. I'll also just mention we're looking outside of MIT at 30 or 40 other platforms just to understand either both open source, all the normal suspects, and then private organizations that have solutions to say, how do they compare? How can they meet the needs of the U.S.? That's strictly a comparative analysis, and then we'll probably take 3 or 4 of those and bring them into a lab environment. So we'll be able to kick the tires and say, can this platform actually do the tens of thousands of transactions per second you would need, or deal with certain really unique problems you have to solve? For instance, denial of service attacks against a Cbdc, I think would be a significant issue of privacy and of cyber resilience. So in a nutshell, that's where we are in Boston.
Well, thanks so much, Jim. It's a great overview. Now, I want to go back to the Libra guys sorry for the colloquialism there. So I understand that you are relatively close to deployment. And I wonder, so as I said earlier, that in my view, Libra has jolted everybody to action. What do you think will happen once you're live? Will this speed up the development of CBDCs, or will it actually possibly slow it down? And the reason why I'm asking is this is that the Bank of Canada said that there's two reasons why they would issue a CBDC. Number one would be if people lose the ability to pay in cash. And number two is there's a replacement effect where people will stop using the Canadian dollar for payments and use some stable coin or something like Libra coin. Now, for instance, the latter part could easily, if you have a stable coin in the Canadian dollar, then that's not going to be a problem. And I think the same argument would apply to many other central banks. So the ECB says we're failing the European customers because we don't have a unified payment system. You could be that unified payment system. So with your development and your deployment, what will happen thereafter? So first, I would like you to maybe give us a bit of a timeline, and second, I would like you to give us a little bit of an outlook of how you think the world will react to you.
Yeah, I can get started, and then Dante can add more detail. So on the timeline, as you can imagine, a lot of this is in the hands of the regulators that we're in touch on a regular basis as we move towards a phased approach to launching. But I think it's really important to stress that the economic design of Libra is one that already assumes that at some point we will have some form of CBDC, whether it's wholesale, synthetic, or in some other shape or form that maybe a project like the MIT one will be able to identify. And so the idea is really to be upgradable for that moment in time and to essentially stop operating, let's say, a reserve for a Libra dollar and connect directly with the public sector effort. To your issue around, is this going to accelerate or not? One way you could think about, Libra as a payment network is that it will allow central banks to really understand what are the additional use cases, what is actually valuable to the market, and what does the public sector need to build out versus not. So you can think of it as a small-scale experiment of what new and kind of seamless real-time payment rails can add to the economy. At a high level, we're really looking forward to efforts on the public sector side because it would also streamline our own operations. So right now, we're going to be the first stablecoin that went through the Basel III framework. And as Dante was already mentioning, our process with FinMan Switzerland is very similar to a full license that a bank would go through in Switzerland. And we've applied, traditional frameworks from the financial sector in the design of the reserve. That, of course, requires us to not only ensure always one-for-one backing, but also to add additional collateral for absorbing potential losses on credit, market, liquidity, and operational risk. If there were such thing as a CBDC, that streamlines and reduces our cost structure dramatically. And that really proves the point that we don't see ourselves as a competitor to a public sector effort in this space, just as a layer on top that can enable additional functionality. That said, I don't know, Dante, if you want to add any additional thoughts on this particular issue.
Yeah. Well, Andreas, thank you. I think the moniker Libra guys might play well in our podcast, so appreciate that. The other point I would like to make is we have to recall that the vast majority of money in circulation today is privately issued. The only time we're getting a little agitated is when the private issuance is in digital form. But to Christian's point, the effort that we are trying to go through, I don't think has too many comparisons in the financial sector in terms of review, in terms of application of different aspects of regulatory frameworks. And the aim here is to build a very safe system, one that gets us as close to a near peer of central bank issued money. So we would welcome the advent of CBDCs over time, and then would focus on the other aspect of this project, which is the interoperable payment system that supports digitally native payments, programmable money, a whole host of use cases on the movement of money that by today's standards are simply not possible.
We may have lost our moderator.
He's got a triangle there.
Yeah, looks like Andrea. We lost Andreas a bit.
Yeah, I'll answer a question.
Yeah, I'm so sorry.
Yeah. Back.
Well, that's great. So I was not so much after the question of whether you see yourself as competition, and I think it's quite clear that you would benefit actually in many ways in terms of functionality. But I would really be interested in what the reaction would be from what you think as the reaction would be from the public sector. Do they actually see you as competition? Not so much, but how you see it.
Yeah, I mean,
if you could just talk a little bit more on that.
No, that's fine. And I thought I broke your screen when I answered the first round of questions. So no, look, I think the goals broadly speaking are very aligned. I've not interacted with anybody in the public sector, whether it's from the central banking perspective or the financial compliance perspective or otherwise, that don't subscribe to the concept of we have reached a point of diminishing returns with our financial system. We have 1.7 billion people who are unbanked entirely, hundreds of millions more who are underbanked. And in a pandemic, the best thing we could resort to was physical checks. I mean, anybody looking at the current state of play of the financial system would argue for more competition, approach to this work that is principle-based and that advances the playbook. I think everything Morten has described from the Bank for International Settlements is an operating model that's very consistent. But eventually, we have to accept that we can no longer treat these concepts as abstractions. We have to start spurring capital, innovation, and actual real work. There are real people waiting on the sidelines for these conversations to yield action.
Okay, so I want to ask one more question, which is something that as a general question, and anybody at the panel can address it. So we hear a lot about trade-offs when it comes to privacy and traceability and the like. And I'm wondering, is there a public consensus that we need to have traceability? Is that really something? I mean, we have never asked people if they want to be traceable. People have the ability. At the moment, people still have the ability to use cash and to avoid traceability. Somehow there seems to be this consensus among regulators, bankers, that this is a must and this is legitimate. Is that actually true? Are we not potentially creating a problem there when we are go down a route where everything will be traceable in principle? So this is a question of the design of a CBDC, which can also be designed to be private by design. Maybe whoever wants to answer it and wants to take it, go ahead.
This is Jim. I'm not a policy guy, but I'll just make one comment. Is in Boston we have a phrase that's let's not pave the cow paths. That gives you Boston-style roads. So the way we like to think about this is we have to stop the bad guys, because I would presume, once again, this is not policy, this is Jim, that barring any sanctions in place or barring any controls, we'd be in a much more serious place than we are today. So I think we need to try to stop those bad guys. It may be the current model is not the best way of doing it, but I think there are ways with the CBDC and other technologies that we can preserve privacy as much as possible, but still have just enough traceability to stop the bad guys, but not expose the data, not exposing the data to the masses or to anybody unless there's a particular hit or something where we get money going to a suspected bad person. We have technology, we think we can do that. And so I just say that I don't think it's an either or. I think there are ways of making things better, and I think this is how we're trying to approach this is, not paving cow paths.
Okay.
I'd weigh in on how this trade-off is being thought of in China. They talk about controllable anonymity, 可控秘密. And it sounds kind of Orwellian and sounds like it's a misnomer. But what they essentially mean is that they believe that private sector actors currently are not providing nearly enough anonymity and privacy. They want you to be able to transact with somebody without that person knowing who you are. And they want you to be able to transact without disclosing so much information that can be used in all sorts of areas, like e-commerce business. But what it looks like is that the Cbdc is going to control the ledger, and it's going to be able to see everybody's transaction in real time. And one of the former head of the Research Institute of Digital Currency there said that the PBOC would have also access to everybody's information of their identity. And I think that's probably an extreme that nobody else is going to want to do, having the central bank have real-time visibility into everybody's transacting. That sounds pretty scary. But there are ways to do it kind of like Bitcoin does it now that I think kind of strike the balance that Jim was talking about earlier, where, for example, you have a law enforcement that you're required to get a warrant to be able to ask the wallet provider to provide the identity to an individual. So you might have a list of all the transactions, but with no names, and maybe shaded in a way that you can't actually back out an individual just by knowing one of their transactions, like you can do in Bitcoin. There are many other ways, like if you consider the fact that you can transact, again using a Bitcoin example, you can transact on Coinbase without creating a record of a transaction on the blockchain, because within the wallet of Coinbase, you could create that kind of system as well that limits the central bank's ability to access data in real time, or identify data in real time without a real need for it, but still preserves without adding a backdoor into the system. You don't want that. But some sort of law enforcement access, I think there's no way to do it in which you're essentially, like I said, with BCE/EP, you're operating, there's a payment system associated with this. It's not just, issuing, printing money and then setting it out. I think that there's no way, it's untenable from a policy perspective.
Maybe I could chime in, Andreas, for briefly, if I may.
Yeah.
On a sort of a broader topic, I think when Jim said, I'm not a policy guy, I'm a technology guy, I think that's exactly the trade-off. I think that the sort of the trade-off here is between, or the conflict, if you will, not the trade-off, but the conflict is between technology and policy. Technology exists at the very, very significant level. And starting out with Bitcoin, then Ethereum, then DeFi, then Libra. Technology exists. Encryption technology exists. Consensus protocols exist. And blockchain is a very, 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 very vibrant sort of development community. Enterprise level, government level, private level. So technologies are on the policy level. There is this, the sort of a natural reaction to it. What if, what if something else happens? Because at the policy level, if you make if something works out, you don't get the upside. But if something doesn't work out, you get, you have to go and explain to Congress why something didn't work out, right? So, so my feeling is that one way to educate regulators and policymakers is by allowing experimentation, technology being deployed, looking for these things. And another thing that came out is sort of geopolitical aspects. Money is a political issue. It involves the public, and therefore it's political. People have to have the ability to explain, to express sort of their preference. What do they want? How exactly they want this to be done. Well, how do you find out? You offer them opportunities, and they typically like to have more choices, not fewer. They typically like to have things faster, not slower, and so forth. Somebody has to pay for it. How do you pay for it? Geopolitical aspect is a very, very interesting conversation on China, is that digital technologies are global, but regulations are national, right? So you have a global digital sort of potential protocol that has to be dealt with at a national level. And there is this contradiction. I like how you pointed out this idea about, the national banking system. And one of the things about the national banking system in the U.S., as you remember, it happened after the Civil War. And one of the points of creating, and there were lots of perks given to national banks, and OCC as the first regulator came out, and massive perks. And that was to unify the country after the Civil War. I mean, that was sort of the idea. Now we're in the environment where, maybe we need to unify the world because we're facing issues such as the global pandemic, the global, warming crisis, the global, rising of the seas, the global, terrorist issues. These are global. So we want to unify things now globally through something. So these are just sort of my thoughts. Thank you.
Well, thanks, Andrei. I'd like to go to some of the questions that were put in the chat, and I apologize that this took me so long to get to that point. I have a question for Morten, which is if you could answer very briefly. Do you think that the DCEP, so the Chinese central bank's Chinese CBDC, will gain widespread international use? Is that actually maybe a policy goal, or is it not?
That's a great question. It is. I am extremely skeptical about this for a few reasons. They always have this throwaway phrase that it's also going to benefit internationalization of the RMB. One, I mean, we're talking about a retail, not a wholesale CBDC. So how many of these at a large scale, all the real transactions are wholesale transactions? Secondly, if the PBOC controls the ledger centrally and has access to all the data, what country is going to be willing to let their citizens use something that's going to create a record with for every transaction with China? And third, there's a real trade-off with capital controls. They don't like to let money out. And so what you'd have to do for that to work is allow people outside of China to buy DCEP themselves and transact with it, which would be a trade-off to the controls that they've so far shown no interest in loosening up. So I've yet to see a single cohesive, sensible way that this new currency actually removes any of the barriers to internationalization that we get currently about 2% of global financial transactions compared to a much larger share of the economy.
Thank you, Morten. So then the next question is about, this top question in the chat asks about the cost of retail banking. And since this is a US conference, let's focus for a moment on the US and not on the internationally unbanked. So maybe this is something for the Libra guy. So the question says, the FDIC asked the unbanked why they don't have an account, and 50% say cost is the main reason. Less than 5% say it's a physical distance to the branch, which I cited before. So, okay. But do you think that you guys from Libra, there we have it again, good for your blog, for your podcast. Do you think that you can bring that cost down, that people can have free access, for instance, to your coins?
So, this is one of those questions where technology alone is not a panacea, and I think if we've surfaced anything in this panel, that you need to have a multi-pronged approach, right? The United States has a couple of fairly insidious aspects of our banking system. One of them is that when you hit a low level, a low account balance, you suddenly are introduced with non-sufficient funds fees. That's a policy choice that we could make as a country to say that, we should have free basic banking, much as you might have in Europe, as a policy provision. And no technology can change the operating model of the basic economics of access to the financial system. But now, on the other hand, when you contemplate a rural community or you contemplate the distance of getting to a physical bank branch, the advent of mobile native banking systems, payment systems, fintech innovations that can sort of lower the basic cost of service, I think this is not only in keeping with concepts about is it really your money if you have to ask someone to pay it and if you have to pay someone to hold it. I think some of these first types of principles can be enshrined in money, can be enshrined within the four walls of the existing banking system without disrupting it. But you need policy, you need technology, and you need innovations that support, new use cases and competition in order to get this blend right. So the short answer is yes, that's exactly what the Libra payment system is being designed to address. It's being designed to address greater control for people the four S's of payments: send, spend, save, and secure their money in a mobile and internet sort of native way. So over time, the market will drive how that then evolves, but that's what we're designing for.
Thank you.
And just to add to that, I really briefly, I think, often this is the result of the lack of competition. So if you take cross-border, often the excuse is that some regions have higher cross-border costs because they're very high AML, CFT compliance costs. But then if you look at the data, the margins are high when the market structure is concentrated on one of the two endpoints, right? And so that's where we can really make a difference.
Thank you, Christian. So very briefly, I want to go back to Morten for one moment because I've pretty much ignored you for most of the half hour. There's a question that we have on the functioning of monetary policy with, Libra, cryptocurrencies, and possibly also CBDC and the effectiveness thereof. to what extent is that a concern in the discussion among the various central banks in the world?
Well, so it's obviously always a concern, but I would, but also there's a lot of positive things. I think you hear the Libra guys talking now. I think they learned their lesson. Don't try and mess with monetary sovereignty. So I think that's going to make their path forward a lot easier. But I think in general with CBDC, all of a sudden you can pay negative interest rate. You can also differentiate interest rates in a lot of ways. So I think just the toolbox becomes a lot more interesting. Whether that's a good thing or bad thing for central banks, I think actually time will show. I could see that you had a heart attack when I spoke about negative interest rates. So that you have the possibility is obviously not the same thing as that you should use it. But I do think in terms of monetary policy, a lot of new options would open up. But then that actually also brings monetary policy to some extent closer to fiscal policy, and whether that's a whole different discussion. So I said a lot maybe without answering your question, so apologize.
That's okay. That's just a panel for you. That's okay. I want to. So we have just about 3 minutes left, and I want to finish with a simple question that I want to ask all panelists, and I want to have a very simple yes or no answer from everybody, please. And my simple question is: would you like to see that the G7 countries all introduce a CBDC within the next 3 years? So yes or no? Let's go through and start with Morten, since we just talked.
No.
How about Christian?
Yes.
Dante?
Yes.
Martin?
No way.
So there was a question of not if it would, but if you would like to. So you would not like to see it?
No, I think it's a bad idea.
Okay, Jim?
I say no only because we're not ready. I say no only because we're not ready yet.
I was about to say, under the assumption that your experiment in some form or another would be successful. So
if we can do it well, if we can do it well and correctly, I'd say yes, but I don't think many central banks are there. It's just too premature.
I agree with that.
Oh, okay. So it's a question of maturity, okay.
Yeah, I'd say no. I'd like it to be private.
Okay, so did I cover everybody? Yes, I did cover everybody. Okay, so we have exactly 2 minutes left. I was asked to finish at 3:58. I'd like to thank all the participants for their excellent questions, and I would also like to to thank the panelists for their answers and for the time that they spent with us. You gave excellent answers to all my questions, and I hope that this was something that the audience generally felt useful. And of course, I want to thank Chorzempa for all her efforts that she put into it and that she enabled us all to be part of this discussion. So thank you for that. And with that, I'm going to hand over to Jim Narron, who will say a few words to close the conference. Thank you.
Andreas, thanks for that. That was an absolutely fantastic session this afternoon. So remember, we started the day with our team talking about the partnerships between big tech and central banks. Of course, through the discussion we had in the second part of the afternoon, we eventually worked our way back to a lot of public-private partnerships as a potential model for moving forward. So really a fantastic session this afternoon. I really want to thank our panelists today. I want to thank the participants who stuck with us most of the day. But mostly I want to thank our organizers this afternoon, of course, Jalapa from here at the Federal Reserve Bank of Philadelphia, but also the organizing team that helped with this, Christopher Feeney, and the sponsorship that we had from the Bank Policy Institute, Richard Herring at the Wharton School of the University of Pennsylvania, Aaron Klein at the Brookings Institute, my old colleague Patricia Moser, who's now at the Columbia University School of International and Public Affairs, and of course, Raghavendra Rao, who's at the University of Cambridge, their Judge Business School, and the partnership with the Center for Alternative Finance. So thanks again, everyone, for joining us, and we really look forward to seeing you next year, maybe in person. Thanks again, everybody, for your afternoon.